Hello, thanks for watching this video. I just want to share a quick strategy with you for trading stocks. This is trading using the 10 and the 20 EMA, and this can be traded to the long side and to the short side, but I'll just focus on the long side in this video. This should be about 10 minutes in total. So let's get into it. So this is a strategy essentially which is following the trend using the 10 EMA and the 20 EMA. It focuses on buying dips, so not buying too expensive, by buying essentially when stocks are breaking out or at new highs. You want to find a stock in a clean uptrend, wait for a pullback down, and then buy the continuation on the upside reversal. The strategy benefits from having a defined risk. You can use a ADR, which is your average daily range. You can use 1 ADR, half an ADR, 2 ADR, depending on your holding period. And then the other thing you can do is you can use the 10 EMA as a trailing stop, or you can use the daily low as your stop loss. Now, if depending on your ADRs and your holding periods, you can end up with large reward to risk trades here. So you can go five times your risk, 10 times your risk. It's all dependent on the stock and the market. So let me just get into some examples of the strategy that I'm talking about. So if we look at a stock like this, this is Astera Labs. This stock has trended up, moved back down, and is now again pushing higher, and it's consolidating a bit at the moment. So I'll look at a present day example. Hood has been one that has traded quite well recently. You can see this stock has got increasing earnings and sales. It's pushed higher. We've come into the 10 and the 20 here, and we've popped from there. So the strategy finds stocks that are trending higher. You want the stock to be up at least 10 to 20% that month. You want to wait for that push higher, pull back into your 10 or 20 EMA, and then you buy on the upside reversal. For instance, here we popped higher. This would be a great spot to buy here, where you touch the 10, and as we're pushing to the upside here, you place your order, and that then ran up 18% over the next 1 week. So your stop loss here might be anywhere from 2.5% to 4% based on that average daily range, which you can see there. If you bought as this candle was forming, with say, call it a 3% stop, after a couple of days, you were already at 3 times your risk. So good risk reward when you do get it right. All the trades don't always work. For instance, you had a bit of consolidation here, but depending on your stop loss, this could have worked, and depending on where you entered, if you entered here or here, that would possibly be a good entry, or you could even enter here as it goes above the 10. So that's the strategy in general. Now, what type of stocks are we looking to trade? Can slim type stocks, so stocks with institutional demand. They're market leaders. You want the market to be in an uptrend as well, so you want the index to be moving higher. You want stocks with growing earnings and sales as well. I would focus on stocks with a market cap greater than 2 billion, because anything less than that, or really the fully small cap stocks, they can trade quite wildly. And as you see in this last point, you want clean price action, because that essentially allows us to follow a trend in a smooth, non-volatile way, which is better for our profit and loss, and also better for our emotions. As you know, in trading, things can get quite emotional. You want the volume to be above 500,000 shares traded daily as well. So when to buy and sell, you want to wait for a pullback to the 10 or the 20 EMA, buy on the upside reversal. So like here, pull back to the 10 or 20. So that the first step is we're in an uptrend. So this uptrend started here, up 70% in 21 days, pull back into the EMA. The EMAs must be separated and rising. So you've got the rising EMAs well separated. You pull back into there, and you buy when it starts to reverse. So here, and here, but these would be stop losses, and you've got a few other options here. Mainly the other option to enter here would be on this candle, this bar here, and this bar here. On this bar, you could have entered as it was forming. So it's come down this way. You could have entered here to about 3%, 2.5 to 5% stop loss. You'd be about flat had you taken this trade now. We don't know what's going to happen, but given the recent news on what's happening in the markets, I've exited all my positions. As you can see, I don't have anything in my portfolio presently, so I don't have any positions due to this Israel-Iran war at the moment. So that's something to bear in mind. So this is quite extended. That's something to watch out for, but obviously an extended market can become more extended. So there are some nuances to this, but in general, this will provide very good trades, very good entries. If you look at something like STX, it's come down here, starts to pop, and it's up 20% in 20 days. And this is a stock with a 3% daily range. Right, so your stop loss, 0.5 to 1 ADR stop loss is what I'd recommend, or stop loss at the daily low. Using the daily low can be tricky if the stock, for instance, has had a big move on the day. Once you exit, part of the profit, I would say take profit at 2 times your risk, and then start trailing your stops at the swing lows. So at 2 times your risk, 2 times R, once you're up 2 times your risk, take half off, move your stop to break even at that point, and then you trail the stop on the remaining position. And if you've got a large enough position, you can certainly scale out more than 2 times if you wish. Looking at this, you can see on the index as well, we push higher, pop into the 10 EMA and go again. Into the 20 here, and we're off again. Here again, we're into the 10 and we move there. And this is the S&P 500, the SPY. Recently hasn't had a lot of range. So up about 2% in 10 days. But in general, you want to trade stocks. So I'll just go through a few. That was on the day of earnings, right off the 10, massive gap higher. Here is a spot that you could be getting into that. Roku, pop higher into the 10 and the 20 here. And we've had a nice run up. Roblox didn't quite get below the 10 or the 20. It's just ran straight up. We had a point where we were at the 10 here, and that's where we've had a big move off. Again, if on a strong trend like this one, you could get in here. It's never touched the 10, but it's close enough to it. What you don't want to do is you don't want to be getting in here, because this could easily come back into the 10 and the 20 and then continue higher. I know this in this particular example, it just goes straight up, but that is usually not the case. For instance, here, if you started buying here thinking it's breaking above these ranges, you can see it comes back into the 10 and the 20, and then it makes its move off of here. As you can see, so this would be a good buying area. This is MU. You could buy here, you could buy there, and both of those would have yielded profits with very little problems in actually getting out with a profit on that. So on this one, you would have had to sit through this pullback, but after that, it was a nice clean 20% move in 10 days. So as you can see, this does provide some good trades. I'm going to end the video here. If you got to the end of the video, I do thank you very much for watching, and good luck in your trading.